Right now, somewhere in America, a 34-year-old nurse is eating instant noodles for the third night in a row. Not because she's struggling to find work. She has a great job, she earns decent money, but every single month, $847 disappears from her bank account before she can even think about rent, groceries, or saving a single dollar. That money goes to a loan she took out at 18 years old to pay for the education that got her the job that pays the loan that never seems to go away. She is not alone. Over 43 million Americans are trapped in the exact same cycle. The total student loan debt in the United States alone has crossed $1.7 trillion. That is more than the entire GDP of Australia, more than every credit card debt in the country combined. And every single year, that number gets bigger. But here's the thing that nobody explains properly. This crisis was not an accident. It was built, piece by piece, over decades. And to understand how the whole machine works, you need to go back to where it started. Imagine you're 17 years old. Every adult in your life, your parents, your teachers, the guidance counselor with the motivational poster on her wall, every single one of them tells you the same thing. Go to college. Get a degree. That is the path to a good life. Nobody hands you a spreadsheet. Nobody shows you what $40,000 in debt looks like at 7% interest over 20 years. They just point you toward the application form and tell you it will all work out. So you sign. Most 18-year-olds have never signed a legal contract in their lives. They have never paid a bill, never negotiated a salary, never thought about compound interest. But they sign for tens of thousands of dollars as casually as agreeing to the terms and conditions on a free app. And the system counts on exactly that. Here's where it gets genuinely strange. In most countries, if you cannot afford to pay back a debt, you can eventually declare bankruptcy and start over. Student loans in America do not work that way. In 1976, Congress changed the law to make federal student loans almost impossible to discharge through bankruptcy. Private loans followed later. The reasoning at the time was to prevent abuse, to stop people from getting a degree and immediately wiping the debt. But the unintended consequence was enormous. Lenders suddenly had zero risk. They could give out loans to 18-year-olds with no income, no assets, and no credit history, and the government guaranteed they would get their money back, no matter what happened to the student. When lenders have no risk, they stop asking hard questions. And when lenders stop asking hard questions, universities notice. If students can always borrow more, universities can always charge more. Between 1980 and 2020, the average cost of a four-year university in the United States increased by over 1,200%. Adjusted for inflation, that's roughly 8 times faster than wages grew over the same period. The price of a degree did not rise because the quality of education improved 8-fold. It rose because the money was always there, ready to be borrowed. Now, layer in the interest. Federal student loans in the U.S. currently charge between roughly 5 and 8% annually, depending on the type. That sounds manageable until you understand how the math actually works on a 10 or 20-year repayment schedule. A student who borrows $30,000 at 6.5% and pays it back over 20 years does not repay $30,000. They repay closer to $54,000, nearly twice what they borrowed. And if they pause payments at any point because they lost a job, got sick, or simply could not keep up, the unpaid interest does something called capitalizing. It gets added to the principal. Now they owe interest on the interest. The hole gets deeper while they are standing still. This is the part that quietly destroys people's lives and rarely makes the headlines. It is not dramatic. There is no single moment of disaster. It is just a slow, invisible erosion. Year after year, the balance stays stubbornly high. Year after year, the monthly payment eats into money that could have been a down payment on a house, an emergency fund, a retirement account, a child's future. Research from the Brookings Institution found that nearly 40% of borrowers who started college in 2004 were expected to default on their student loans by 2023, not because they were irresponsible, because the system was designed in a way that made success genuinely difficult. And this crisis does not hit everyone equally. First-generation college students, often from lower-income families, borrow the most and have the fewest financial safety nets when things go wrong. Black borrowers in the United States carry, on average, significantly higher student loan balances than white borrowers 4 years after graduation, largely because of wealth gaps that mean less family financial support. Women hold nearly 2/3 of all outstanding student loan debt in the country, partly because they are more likely to attend graduate school for fields like social work, education, and healthcare, fields that are historically underpaid despite requiring advanced degrees. Outside the United Kingdom, the picture looks different but no less complicated. In the United Kingdom, graduates repay 9% of everything they earn above a threshold, currently around £27,295 per year, for up to 40 years before the remaining debt is written off. The interest rate was tied to inflation plus up to 3%, which in 2022 sent some loan balances rising at over 12% annually. Many UK graduates will never fully repay their loans in their lifetime. The debt functions less like a traditional loan and more like a graduate tax, except one that accrues interest while you're paying it. Australia's HECS-HELP system is often held up as a better model. Repayments are income contingent, meaning you only pay when you earn above a minimum threshold, and the debt is indexed to inflation rather than a higher interest rate. But even there, a sharp rise in inflation in 2022 and 2023 saw student debts jump by 7.1% in a single year, adding thousands of dollars to balances overnight through no action of the borrower. The human cost of all of this is not just financial. Studies consistently link high student debt to delayed marriage, delayed home ownership, lower birth rates, and higher rates of anxiety and depression among young adults. An entire generation has had its financial life shaped and, in many cases, stunted by a decision made at 18 with incomplete information, enormous social pressure, and essentially no exit. Some solutions have been tried. The U.S. introduced public service loan forgiveness in 2007, promising to cancel the remaining balance of federal loans after 10 years of payments for those working in qualifying public sector jobs. The program was announced with enormous fanfare. In the first year borrowers became eligible, 2018, the approval rate was 99% rejection. The paperwork requirements, the specific qualifying loan types, the specific qualifying repayment plans, the conditions were so intricate that almost no one met all of them simultaneously. The people who designed their careers around that promise were left with nothing. Income-driven repayment plans offer another path, payments capped as a percentage of discretionary income, with forgiveness after 20 or 25 years. For many low earners, this helps. But for middle earners with large graduate school debt, 25 years is a long time to wait. And until recently, the forgiven amount at the end was treated as taxable income, meaning someone who had a $60,000 balance forgiven received a tax bill for tens of thousands of dollars the same year. What is perhaps most striking about this crisis is not the numbers. Numbers get abstract quickly. What is striking is how ordinary the people trapped inside it are. The nurse eating noodles, the teacher who took out loans for a master's degree required for a promotion that raised his salary by $3,000 a year, less than his annual loan payment. The social worker helping families in poverty while owing $90,000 for the graduate degree that qualified her to do it. These are not cautionary tales about reckless borrowing. These are the logical outcomes of a system where the cost of education outgrew the wages education was meant to unlock, where the promise made to an 18-year-old was real, but the fine print was written in a language no teenager was taught to read. Understanding that does not fix the debt, but it is where fixing it has to begin.